So whether the audio and visual is clear? Okay. So please everyone join live very fast. We'll start with revision regarding this particular concept. So first we will start as I already said. First we are going to start with the areas relating to the dividends. Once a dividends concept is completed, then we will be moving on into the other areas. Fast, sir. Please share the link that I have shared to you with your friends as well. Ask them to join fast. Live session means you should participate in live and complete, such that you need not again revise separately. So let us begin. So hello all. So today we are now assembling for the CA Inter FM revision for the coming examination. Relating to the financial management, we are going to do a super express revision, starting with the first topic, dividend decisions, and followed by the other topics like cost of capital, capital structures, etc. So with regard to the today's session, we are going to start first with the dividends area, wherein we are going to cover all the concepts that are given by the study material, starting from the Walter model, next one being the Gordon and Modigliani-Miller approach, and finally the Linter's model. So, and a two-stage dividend model also, how to calculate when a question comes in examination relating to two-stage dividend model also we are going to discuss very clearly in detail. So let us start with the session. So before we begin, everyone please put a comment. Shall we begin? Shall we start with the revision? Yeah. So let us begin. So please, everyone participate, and moreover, this session is not to listen. This session is to do. So do along with me. Please don't sit idle. Okay. When a question is being done, you do along with me. Let's complete. Okay. So I will not tell what is the target, how many. Let us start as many topics as possible. Let us try to complete them. Okay. You will also get a clarity. Let's begin. So relating to the marathon, first chapter, we are going to start with dividends. Okay. First, in the dividends chapter, we are having the following concepts: Walter model, Gordon model, next one Modigliani-Miller model, next one Linter's model, two-stage dividend model. Walter model is a no growth model. No growth model. Which model? Walter. Gordon model is a dividends with growth model. Modigliani-Miller is a non-impacting model. Means dividend whether you declare or do not declare, the wealth of the company do not change, is the assumption of Modigliani-Miller approach. Linter's model is not at all a share pricing model. It is only dividend declaration model. Two-stage dividend model is a unique methodology that we will see at the last. Okay. Let us first start with the Walter model. Walter model says price of the share equal to D plus, okay, D plus R by KE into E minus D whole divided by KE. D means dividend per share. R is return on equity, also called as return on investment. KE means the cost of equity. E minus D means retention. Divided by KE means cost of equity. Cost of equity, another name is capitalization rate. Okay. Next, Gordon model, there are two types of formula. Okay. P naught equal to E into 1 minus B. Technically it is E1 into 1 minus B whole divided by KE minus B into R. E1 means earnings per share next year. 1 minus B. B means retention proportion, not retention amount, retention proportion. Proportion is always said in the percentages or in points. Say for example, I can tell as 40% or I can tell it as 0.4. Okay. Next, KE, cost of equity, minus B, retention proportion or return on equity. Okay. Or this is one formula. P1, P naught equal to earnings next year into 1 minus retention. Retention means not paid. Not paid is retention. 1 minus retention means paid. So simply this can be written as D1 divided by KE minus G. Okay. First let us do some problems on Walter and Gordon model. Okay. Let's begin. I will take directly the illustrations and try to solve. First, okay. Okay. See here. The following information is supplied to you. Total earnings 2 lakh. Total earnings is 2 lakh. Just a minute. Total earning is 2 lakh. Next, number of equity shares 20,000. Dividend paid 1 lakh 50. Price earnings ratio 12.5. Sir, why price earnings ratio is given? Remember, whenever P by E ratio is given, KE can be calculated as 1 by PE ratio. So 1 by 12.5, 1 divided by 12.5, 0.08 also called as 8%. KE in this question is 8%. Remember always KE, if PE ratio is given but the KE is not given, 1 by PE ratio is the KE. So KE equal to how much percent here? 8%. How much it came to? 12.5. Okay. So analyze whether the company is following the optimal dividend policy. As per the Walter model, they said like this. Compare the R, compare the KE. If R is greater than KE, equal to KE, less than KE. If R is greater than KE, 100% retention. If R is equal to KE, indifferent. Whatever you want, you do. If R is less than KE, 100% payout. 100% payout means 100% dividend. In this case, let us see what is the scenario. Okay. What is the KE you calculated? 12.5. What is the KE calculated? 12.5. Okay. Next. Sir, here R is not given in the question. What is not given? R is not given in the question. Okay. Listen now. Whenever R is not given separately, here if you observe, dividend paid is given. How much? How much? 1,50,000. Per share, how much it will be? Per share. See, 1,50,000 divided by 20,000. Okay. Number of equity shares 20,000. Dividend paid 1,50,000. 1,50,000 divided by 20,000. How much? 7.5 you paid. So forget about it. I will tell you one important concept. Let us try to understand. Fastly, let us do this question. Question number 2, ISM. Selected questions. A question which contains all the points, we will do that. Okay, that way we will proceed. Everyone start calculating. Don't sit idle. This is not the time to sit idle. Let me copy down this question. Yeah, let us solve. First one, step 1. Like this only you have to do in exam. Formula: P equal to D plus R by KE into E minus D whole divided by KE. Whole divided by KE. Okay. Now listen carefully. In this particular scenario, KE equal to 1 by PE. So 1 by 12.5, 8%. Number 1. Number 2, R. When R is not given, how to calculate? Listen carefully to this point. Okay. In this question, earnings is given or not? Yes, given. Number of equity shares are given or not? Yes, given. How much is the par value of a share? 100. How much is the par value? 100. Par value can also be understood as book value. Par value can also be understood as book value. If reserves are also given in the question, listen to my words. If reserves, not earnings is this year earning. Reserves are also given. Reserves plus equity. Reserves plus equity or equity plus reserves divided by number of shares is the book value per share. Book value per share. So book value per share here is how much? Nothing is said in the question. 100 rupee. Par value is assumed as a book value. There is a formula saying that EPS equal to BVPS into ROE. Okay. Simply BVPS into R is E. EPS we know. Earnings is 22 lakh. Number of shares is 20,000. Okay. Number of shares is 20,000. So EPS is how much? 10. Next, BVPS, we already know 100 into R. So R equal to 10 by 100, that equal to 10%. Okay. So now we have R on hand, KE on hand. R equal to 10%, KE equal to 8%. Situation is R greater than KE. When R is greater than KE, return earned by the company is more than the cost company has to pay them. Means company wanted to pay 8% but earning 10%. Since the earning is more in the hands of company, 100% retention. See here. Analyze whether the company is following optimal dividend policy. As per this question, company should follow 100% retention, but the company has paid dividend. Analyze whether company is following optimal dividend policy. No. But you should write entire analysis in exam. Don't just write no and close the answer. Okay. Next. Compute PE ratio at which dividend policy will have no effect on the value of the share. When the dividend decision will not impact, when it will not impact is when R is equal to KE. When R is equal to KE. If R is equal to KE, dividend whether you declare, do not declare, price of the value of the share will not get affected. When R is equal to KE. He is asking R is how much? R is how much? R is 10%. So KE also should be how much? 10%. If R and KE are 10%, then R by KE strikes each other. Okay. How the formula will be? D plus R by KE into E minus D whole divided by KE. If R and KE are same, what will happen? 10%, 10%. Both strikes each other. D plus E minus D by KE, minus D plus D cancel. E by KE will be the formula. Dividend has no impact on the price. That's the derivation of this formula. Okay. But how to write this? Compute the PE ratio at which dividend policy will have no impact. Okay. When dividend policy will have no impact? When R is equal to KE. So KE should be equal to 10%. KE should be 10%. Means how much should be the PE? KE equal to 1 by PE. PE equal to 1 by KE. So 1 by 0.1 equal to 10 times. So answer for the second bit is how many times? 10 times. So if the PE ratio is 10 times, KE become 10%. If KE is 10%, R and KE both are same. If R and KE both are same, dividend policy has no impact on the share price. Next, Will your decision change if PE ratio is 8 instead of 12.5? Obviously, answer will change. If PE ratio is 8, KE will become 1 by 8. So, KE equal to 12.5%. Now, KE is greater than R or R is less than KE. In this case, company should go for 100% dividend and 0% retention. This is the answer for this question. Everyone in the class answer? Understood or not how to do this? This one question covers entire Walter model. Everyone, reply. Okay. Next one. This question number 3, this is helpful to do Gordon and Walter in the same question. With the help of the following figures, calculate the market price of the share using Walter, using Gordon. Okay. So, EPS 10, dividend 6, cost of capital, internal rate of return also called as R, retention ratio also called as 0.4 retention proportion. Okay. Everyone start doing, keep the heading. Illustration number, question number 3. First, D equal to, write down the data, D equal to 6, E equal to 10, KE equal to 20, R equal to 25, B equal to 0.4. Start doing, everyone. Walter. First write the formula, practice in the class here itself. D plus R by KE into E minus D whole divided by KE. 6 plus 25% divided by 20% into E minus D whole divided by 20%. 25.25 divided by 0.2 into 4 plus 6 divided by 20%. Answer should be 55. Everyone, have you got the same answer or not? Confirm. Answer should be 55. Have you got the same answer? Answer should be 55. Okay. Next one. So the price of the share came to 55 rupees. So this is the price as per Walter model. Okay. Next one. Do as per the Gordon model. Do as per the Gordon model. So as per the Gordon model formula, since retention proportion is separately given, E into 1 minus B divided by KE minus B into R. Earning 10, 1 minus 0.4 divided by 0.2 minus 0.4 into 0.25. 1 minus 0.4 into 10. 6 divided by 0.4 into 0.25. 0.1. Okay. Price is 60. Shall I tell you one thing? You should do and answer before I answer. Because you are writing exam, not me. Practice, complete here itself. Today, if you can complete the marathon along with me, a lot of burden will be removed for you from in the tomorrow's preparation. Okay. So the price came to rupees 60. So now we completed both Walter and Gordon model for the given question. Okay. Next, let us have this question on hand. A&R Limited is a large cap multinational company listed in Bombay Stock Exchange in India with a face value of rupees 100. The company is expected to grow at the rate of 15% per annum for the next 4 years, then 5% for an indefinite period. Shareholder expect 20% return on their investment. Company paid rupees 120 as dividend per share for the current financial year. The shares of the company are traded at an average price of 3122 on the last date. Find out the intrinsic value per share and state whether the shares are overpriced or underpriced. This question is on two-stage dividend model. Next examination, this is my expectation. This question may come, may not come. This model will come in examination this time. Okay. Read the question once. Once this is also completed, linter model also I will show you. Okay. Formula I will show you for the linter model. Just remember the formula for linter. After that, we will go into Modigliani-Miller, the most important model of this chapter. Okay. Everyone, please see there, read the question once. This model is an expected question for this attempt. Read the question first. Okay. Let's solve. See here, how to solve this particular question. Whenever two-stage dividend model comes, how question will be framed, I will tell you. They will give the data in such a way that there will be an investor, that investor will have a time horizon. Time horizon means what? The investor who enters into the market by purchasing a share will not be there in the market forever. For lifetime, till perpetual succession of company, human beings will not have perpetual succession. Therefore, I don't want it to stay in the market for long. I will invest a share today with an intention to sell it after some number of years. Okay, some number of years. I wanted to hold it for some years and I wanted to sell. In the question, this fellow, the investor, wanted to hold the share for next 4 years. Like that, you have to understand. Means the investor wanted to hold the share for a period of 4 years. At the end of fourth year, he wanted to sell the share and leave from the market. Okay. Now listen carefully. First year, okay, I will stay in the market for how many years? 4 years. Therefore, first year I will get dividend. Second year I will get dividend. Third year I will get dividend. Fourth year also I will get the dividend and then I will sell the share. Okay, I will sell the share when? Today na, after 4 years, after 4 years. Means I want P4. P4, P0 equal to D1 by KE minus G. P4 equal to D5 by KE minus G. D5 by K minus G. D5 can be written as D4 into 1 plus G divided by K minus G. This concept you need to remember. Okay, let's do together. Question number 5. Year cash flow PV at the rate of 20%. PVCF. Okay, let's start. 1, 2, 3, 4, 4. Sir, why sir 4, 4? First year I will get dividend. Second year I will get dividend. Third year I will get dividend. Fourth year I will get dividend and then I will sell. Therefore, this selling price is called as X dividend selling price. Which dividend? X dividend selling price. Why X dividend? You are getting the dividend for the fourth year and then you are selling it. Therefore, you are getting the dividend. Once dividend is declared, the share becomes X dividend share. Okay. So, always in a two-stage model, unless they mention in the question clearly, sale is always a ex dividend share only. Okay. Okay. Now, so already what is the dividend that the company declared? Company paid for the current financial year, means it is D0. How much growth for the next 4 years? 15%. So what he is saying is, for this period 15%, okay, for the other period it is only 5% is what expected. This is a question. 5% for indefinite period. Logics don't ask now. Classroom, I can tell 1,000 logics on why they are doing like this. This is not the time to learn logics. This is a time to solve the questions. Now marks are more important for me rather than what you understood. Okay. Okay, start. Tell me, first year how much I will receive? First year 120 plus 15%, 138 plus 15%, 158.7 plus 15%, 182.51 plus 15%, 209.88, 209.88. Fourth year ending, after getting the dividend of 209, after getting the dividend of 209, I am also selling the share. Okay. P4 equal to D5 divided by K minus G. D5 can be written as D4 into 1 plus G divided by K minus G. Okay. D4 209.88 into 1 plus, this is a perpetual period. Okay, you are selling. Selling means you are leaving the share and you are going out. So for the indefinite period after you sell, you are expecting a growth of 5%. So 1 plus 0.05, 1.05. KE 20% minus 5%. 209.88 into 1.05, okay, divided by 15%. 1469.16. 1469.16. PV at the rate of 20%. 1 divided by 1.2, 0.833. 3 digits you round off. 0.694, 0.579, 0.482, 0.482. Both belongs to the same period. Okay. Now directly do the M plus and tell the calculation. Everyone reply the answer. 0.833 M plus 158.7 into 0.694 M plus 182.51 into 0.579 M plus 209.88 into 0.482 M plus 1469.16 into 0.482 M plus MRC, okay, 1140.06. So please tell whether the calculation 1140.06. Have you got the answer or not, everyone? Everyone, see here. See. They applied the numbers and they calculated this way. They applied the dividends, everything was calculated. Okay. So 1140.06. You please calculate, everyone, confirm the answer once. Everyone got the answer? Yeah. So the main point is, see here. Okay. Like that they have considered. Okay. But the point you have to understand here is why the institute has got an answer of 1022.42. I told so many times in the class itself. See here. What happened is we are reducing 20% and 5%. 209.88 growth is 5%. They have taken 15%, which is a mistake. Okay. So don't go by the answer of the institute. Nonsense they have done. Clearly in the question they have given that. 5% for indefinite period. Okay. By mistake, what they have done? They have taken the same 15% also here, which is a nonsense. Okay. But by the way, try to understand clearly. Here they have taken 0.05. Okay. So by mistake, printing mistake happened. Here 1.05 should come, not 1.15. Babu, understood the mistake by the institute or not? So don't mug up these answers. Unnecessarily answers will go wrong for you. Clear? Reply fast. We have to do the next question. Reply, everyone. Okay. Yeah. So therefore, there is a mistake with the institute. So forget about it. Let's do the next question. Okay. So we have done question number 5. So two-stage dividend model also I explain how to do the questions if they come in examination. Okay. Next. Sixth question. Mark it most important for the next exam. We will do it now. Okay. After the marathon is completed, tomorrow morning when you wake up, first to do this question. Which question? Question number 6. Without fail, you do. Every chance is there, direct question can come in exam. That's a very good question. Let us start. Okay. In the month of May of the current financial year, shares of RT Limited was sold for 1460 per share. A long-term earnings growth rate of 7.5% is anticipated. RT Limited is expected to pay a dividend of rupees 20 per share. Calculate the rate of return an investor can expect to earn assuming the dividends are expected to grow along with earnings at 7.5% per year in perpetuity. It is expected that RT Limited will earn about 10% on the retained earnings and shall retain 60% of the earnings. In this case, state whether there would be any change in the growth rate and cost of equity. Please read the question first. Read the question first. Important. Very, very important. Mark the question as most important and let us start. Do this question along with me now. Okay? That's it. Practice should be completed in the marathon itself. In the month of May of the current financial year, shares of RT Limited was sold for 1460. Okay? When you read the question, half the answer should be over. Simply to tell, this is the price, P naught, 1460. Growth rate, 7.5. Okay, dividend, expected dividend means D1. So D1 is there, P naught is there, G is there. He is asking rate of return an investor expect means what? KE with a 7.5% growth. Okay, shall we calculate? Let's do. Question number 6. Question number 6. Okay. Question number 6. Do it, everyone. P naught equal, sorry. KE equal to D1 by P naught plus G. D1 20. D1 20 divided by P naught 1460 plus 0.075. 20 divided by 1460 plus 0.075. Okay. See here. This is the expected dividend 20. Price 1460. Growth rate is 7.5%. Okay. Tell me. Tell the answer, everyone. Everyone, fast. Okay. See, 6th question. Let us see here itself and complete. Okay. See, again, I am telling you, Institute have made another small mistake in this. Already they have given expected dividend. See here. See in the question. That's why I am showing you the answer. RT Limited is expected to pay dividend of 20 per share. Okay. Expected to pay dividend of 20 per share means it is expected dividend. Already this is D1. Again, you need not apply any kind of growth to that. Okay. In remaining questions, they have done like that. But in this question, what they have done? They have taken this and again they applied a growth on this. Okay. That's why answer will slightly change. You may now get a doubt definitely, sir. If this be the case, how can I understand, sir? Which question? That's why answer always should contain assumption. Whenever question is unclear about anything, just write down an assumption. It is assumed that, okay, it is assumed that the dividend declared is the expected dividend, which is D1. When the question itself is clear, dividend already paid, they said, don't assume it as expected. Don't assume it as expected. When the words expected dividend comes in the question, okay, you just write down an assumption, assumed that the expected dividend is D1. Okay, so that's the point. So in that case, slightly our answer will change, and moreover, our answer is more correct than what Institute has done. So it is 8.87%. Here they got 8.97%. A small little change will come. Okay, 1 point is over. This is A bit. Come to the B bit now. Come to the B bit. See the question. It is expected that RT Limited will earn about 10% on retained earnings and shall retain 60% of the earnings. In this case, state whether there would be any change in the growth rate and the cost of equity. Okay, listen carefully. Point number 1. How much is the return earned on the retained earnings here? 10% on retained earnings. It is expected that RT Limited will earn 10% on retained earnings, means R. Okay. And 60% will be retained. Percentage of retention 60 means B. B into R they have given. B into R they have given. So B into R will be called as what? Growth. Growth will change or will not change? Will change obviously when these numbers change. Okay. Write down. Revised growth. G equal to B into R. Okay. B 0.6, R 0.1. 0.06 or 6%, or how much? 6%. Okay. So again, one person asked the question. That's why that's assumption. I said in the class very clearly. If you make assumption that it is expected for the current financial year, it will be considered D0. If you expect that it is going to happen for the next year, then you will consider it as a D1. Write down the assumption in exam whenever there is a concept clarity is missing in the question. Then which expected dividend, current year expected dividend or next year expected dividend? If there is no clarity, write assumption and do the problem. That's what I said. Okay, let's come back. So revised growth rate is how much percent? 6%. Listen carefully. From here I will show it here and directly I will solve. First one, growth has changed. Okay. See here once. Listen carefully. Previously, what is a growth rate? 10. 7.5. And what is the growth rate now? Now the growth rate made 10%. Previously, what is the R? 10%. Nothing is said, na? Same R is applicable also at that time. Okay. Previously, growth is 7.5. 7.5 means G equal to 0.075. G equal to B into R. Okay, B into R. So 0.075 equal to previously what is the retention? We don't know. Into R 0.1. B equal to 0.075 divided by 0.1. How much? 75%. How much? 75. So 1 minus B is how much? 25. 1 minus B is 25. So B1 and payout 0.25, 0.75. With the 25% payout ratio, EPS will be as under. Okay, EPS will be as under. See there, D1. Okay, D1. Here if you see 20 rupees, this is the dividend that is expected to be paid. Divided by 0.25. Divided by 0.25 means the payout. Means totally how much is the earning? 80. So earning 80 la 40% is retained. Means how much dividend will be paid? 32. Sir, I did not understand this calculation. That's why I said this is complicated. Let us do here. Revised growth you calculated na? Let's continue further. This is number 1. Number 2. Calculation of revised KE. Calculation of revised KE. If you do this problem now, you will solve in exam. I am very specific about it. So see there. First, old growth 7.5. New growth 6%. Okay. Old and new are 10%. Okay, calculated. Now we want new KE. KE equal to D1 by P naught plus G. However, understand this properly. However, this D1 should not be on the basis of the old growth. This should be on the basis of the new growth. Old growth is 7.5. New growth is 6%. On that basis of new growth, you have to calculate the D1. Okay. So therefore, first we need to know the old earnings. Old earnings. Okay. Old EPS. Okay. Old EPS. To know old EPS, EPS will be nothing but, okay, simply DPS is nothing but EPS into payout ratio. EPS into payout ratio. So old EPS into old payout ratio, if you know, old DPS is already given. Old DPS is how much? 20. Old EPS is how much? We don't know. Okay. Old payout ratio is how much? This we can calculate. How much is the old payout ratio? See, old growth equal to P into R. Old growth is how much? 0.075 equal to retention. We don't know. Rate of return is 0.1. So retention came to 0.075 divided by 0.1, 0.75. So payout equal to 1 minus 0.75, 0.25, 0.25. So this we have a clarity now. 0.25. So x equal to how much? 20 divided by 0.25. How much? 80. So the old EPS is rupees 80. Okay. On this 25% payout into 25%. 20 rupees came as a dividend in the question. Okay. Now this percentages have changed now. G came to how much? 0.6. G equal to B into R. G equal to B into R. So G is how much? 6% in this particular case. B is 60%. R is 0.1%. R is 0.1%. So now new DPS equal to EPS into new payout ratio. EPS 80, new payout ratio. Now the retention changed to 60. Payout is 40%. 80 into 40%, 32. So this is the new DPS. So P naught or KE equal to D1 by D1 by what is the KE given in the question? Oh, sorry, KE D1 by P naught. What is the price given in the question? 1460 plus 0.06. That's what they have done here. 32 divided by 1460 plus 0.06. Answer is 8.19%. 8.19%. That's how the answer has come. Everyone understood how the answer has come or not? Everyone, whoever joined live, please give a reply. Did you understand how this answer has come? Okay. So because of the difficulty involved in the question, okay, because of the difficulty involved in the question, I will be repeating one more time the answer very fast. Okay. I will not spend more time. I will just explain you the concept one last time, such that if the same question comes in exam, you will not commit mistake. See here once. Practice in the class itself. First point number 1. In the month of May of the current financial year, shares of RT Limited was sold at 1460. This is called as P naught. Long-term growth rate is how much? G equal to 7.5. Do along with me. G equal to 7.5. RT Limited is expected to pay dividend of 20 per share. If we assume that this is for the current financial year expectation, we will consider it as a D0. Sorry, go with the assumption of institute. You will get the same answer now. If this question comes in exam, assume that this is D0. Okay, current financial year expectation it is. How much? D0. Okay. So first, step 1, calculation of KE. Do one last time, practice. KE equal to D1 by P naught plus G. D1, 20 into 1.075 whole divided by 1460 plus 0.075. 20 into 1.075 divided by 1460 plus 0.075. 8.97%. Okay, up to here clarity. Next, step 2, calculation of revised KE. What they said in the second question, RT Limited, R is 10%. They didn't say that R is changing. Okay, retention will be how much percent? 60%. Previously, retention is not 60. Previously, different retention. How much retention previously? We don't know. Okay, state whether there will be a change in growth rate and cost of equity. Clearly, they said change in the growth rate will happen or not. Is a question they are asking. Okay. See, G equal to B into R. B means retention proportion into return on equity. Okay, retention proportion. Clearly, they said 60% will be retained. 0.6 into rate of return is how much? 10%. 60 into 10%, 0.06 or 6%. One content over. So revised growth is 10%. Sorry, revised growth is 6%. We want revised KE. KE equal to D1 by P naught plus G. If you take 20 into 1 point some amount, 1.075, this will be wrong. Reason, this is the revised growth, old growth, old growth. Correct or not? This is the old growth. And 20 also you should not take, because 20 is not as per 60% retention. Okay, 20 is as per some different retention. We want exactly some EPS into. So DPS is always EPS into payout ratio. EPS into payout ratio. Previously my DPS is 20. This is dependent on some X, okay, into some Y. This payout ratio I wanted to know now. Okay, this payout ratio I wanted to know. Previously, what is the growth? 7.5. And this 7.5 is B into R. So 0.075 equal to R is always 10%. That will not change. B is how much? B equal to 75%. Retention 75. Retention 75. So payout is how much? 25%. So technically EPS into 25%, EPS into 25% came to this 20 rupees. So how much is the total EPS? 20 divided by 25%, 80. So revised dividend equal to EPS into revised payout. EPS how much? 80. Okay, revised payout. Retention is 60. Payout is 40, equal to 32. So KE equal to D1 by P naught plus G. Already this is revised now. They have taken this as a D1. 32 divided by what is a P naught? 1460 plus 0.06. So 32 divided by 1460 plus 0.06. 8.19% is the answer. Everyone, I repeated the answer for 2 times. Understood the concept clearly? Everyone, no delay. Everyone, reply. Okay. Remember the model clearly. It can come in exam directly. Okay. Over. Next. Okay. Now we will do together one question on Modigliani-Miller. One question on Modigliani. This is a 8 marks question came in exam. Do only one question on Modigliani-Miller, but do it properly. Now we are going to start with MM model, the most important model in this chapter. Okay. Let's start. MM model 3 formulae will be there. Okay. First P naught equal to D1 plus P1 divided by 1 plus KE. 1 plus KE. Up here understood? Okay. D1 plus P1 divided by 1 plus KE. Next. MP1 equal to E minus, sorry. MP1 equal to MP1 equal to. Sir, what is MP1? Notation you should know. Na? This is called as amount to be raised by new issue. Amount to be raised by new issue. Okay. I minus E minus ND1. I minus E minus ND1. Next. Wealth calculation. Which calculation? Wealth calculation. NP not equal to P1 into N plus M minus I plus E divided by 1 plus KE. This is not the time to learn the logics. Question comes in exam, how to answer. That's it. That is our target now. Okay. Let us solve the question. Let us take question number 7. Akash Limited has a 10 lakh equity shares outstanding. Start of the accounting year. Existing market price. Here itself you write down P0. Expected dividend D1. Okay. Expected dividend D1. Here institute is directly taking it as a D1. Inconsistency. That's it. Okay. KE 10%. So we have D1, we have KE, we have P0. Okay. D1 plus P1 divided by 1 plus KE. We need to just calculate P1 now. Calculate market price per share when expected dividends are not declared and declared. Two situations we have to do. Okay. Write down. Do it. Okay. P0 equal to D1 plus P1 divided by 1 plus KE. P0 150 equal to D1. How much dividend we are expecting? 8. KE. How much percent? 10%. So P1 equal to 150 into 1.1 minus 8. 157. So same. P1 equal to 165. 165. 157. Okay. First bit completed. Next, calculate the number of shares to be issued by the company at the end of accounting year. At the end of accounting year, on the assumption that net income of the year is 3 crore, investment is 6 crore. Dividends are declared, dividends are not declared. Both the cases we have to do. Okay. See. Right now. Number of shares when dividend is declared. MP1 equal to I minus E minus ND1. I minus E minus ND1. Here I have written. Okay. How much amount we need to raise? We are raising money for what? To put in dustbin? No. We wanted to invest. So how much investment? 6 crore is the investment. Okay. Okay. 6 crore investment we are going to raise by new issue. No. Already some existing earnings are there. How much is the existing earning? 3 crore. Minus 3 crore. Full 3 crore will be available? No. This year we declared some dividend. How much dividend? 8. How many shares are there totally? 10 lakh. 10 lakh into 8, 80 lakh. Okay. So, simply what we have done? I minus E minus ND1. ND1 means old number of shares. Okay. Old number of shares into D1. So, already how many shares are there? 10 lakh shares. Into how much is the dividend declared? 8 rupee. D1 into 8. So, how much we got? How much we got? 80 lakh. So 6 crore minus minus okay. Do it. 3 crore 80 lakh. MP1. Okay. M into P1. P1 157 equal to 3 crore 80 lakh. M number of shares to be issued 3 crore 80 lakh divided by 157. 2,42,038 shares. 2,42,038 shares or 0.22 shares. 2,42,038.22 shares. This is the number of shares to be issued if the dividend is declared. If the dividend is declared, okay, ND1 value you have to take it carefully. N means number of shares already there. D1 is a dividend declared to them. Dividend declared is 8 rupee for 10 lakh shares, comes to 80 lakhs. Comes to 80 lakhs. This is our answer K. Next, if dividend is not declared, do it MP1 equal to I minus E minus ND1. I 6 crore minus 3 crore minus 0. So MP1 equal to 3 crore. M into P1 is how much? 165. 3 crore. M equal to 3 crore divided by 165. 1,81,818 shares. 1,18,818 shares. Okay, done. Second bit also over. Prove that market value of the shares at the end of the accounting year will remain unchanged irrespective whether dividends are declared or dividends are not declared. So our intention is to prove that market value of the shares at the end of the accounting year will remain unchanged irrespective whether dividends are declared, whether dividends are not declared. Okay, see here. Please see here. Market value of the share will remain unchanged at the beginning, at the ending, So see here now. The point is, how many shares are already there? How many shares are already there? Write down. Dividend declared, dividend not declared. Dividend declared, dividend not declared. Dividend declared. Number of shares existing, 10 lakh. Number of shares new, 242,038. 242,038. Okay. So total 1242,038. Here number of shares existing 10 lakh. Number of shares newly issued 1 lakh 81,818. 1 lakh 81,818. Total 11 lakh 81,818. Okay. This particular 12 lakh 42,048. 12 lakh 42,048 number of shares. Okay. So if you observe clearly, how much amount we have raised here? We raised an amount such that we issued 2,42,038 shares when dividend is declared. If dividend is not declared, we have issued only how much shares? 1,81,818 shares. Okay. Okay. Now into 157. 12 crore 42 lakhs 038 into 157. Okay. It came to 19 crore 50 lakh. Next, 11 crore 11 lakh 81,818 into 165. 19 crore 50 lakh. So market value of the shares, the market value of the company in both the cases comes to 19 crore 50 lakh in both the cases. Everyone understood clearly? Yeah? Everyone understood this question clearly? See here. 157, 165, 2 lakh 42, 1 lakh 81, 818, they round it off to 1.82. 19 crore 50, 19 crore 50. Okay. Sir, everyone say one yes. Completed. We completed the question. Everyone. So listen. Sir, in this question, Why, sir, you did not use this formula? Reason is they did not ask the value of the company at the beginning. They asked at the ending. If they asked at the beginning, then P naught we will multiply and we will do. Okay. If the same question, if they tested you, okay, now they tested on ending. If they tested on beginning wealth, then how to do? See here. NP not equal to P1 157 into 157 into N. How many shares are there? 10 lakh. Take calculator. Plus M. 2,42,038. Okay. So 12 lakh 42,038 minus I 6 crore plus earnings 3 crore divided by 1.10. 157 into 12 crore 42,038 minus 6 crore plus 3 crore divided by 1.1. It came to 15 crore. Next, NP not equal to 165 into minus 6 crore plus 3 crore divided by 1.1. 165 into 1,81,818. Okay. 165. Sorry. Plus 10 lakh shares. So totally 11 lakh, 10 lakh plus 1,81,818 into 165 minus 6 crore plus 3 crore divided by 1.1. Both the cases it came to 15 crore. So if the question they asked you on beginning wealth, this is how you need to take. After at the end means nothing you need to do, no great calculation. Already these many shares are there. At the end it will become 12,42,038 into price you got. In both the cases market value of the shares will come to 19 crore 50 lakh. From this what you have to understand as per Modigliani-Miller approach, whether you declare dividend, whether you do not declare dividend, wealth of the company will remain the same either at the beginning or at the ending. So this is the ending proof and this is the beginning proof. Everyone, one yes. Don't sit idle. One yes, everyone. Understood the point clearly? Okay, done. So now we are done with this particular case or this particular concept called as a Modigliani-Miller model is completed with this. Okay. So your work starts now. Okay. After this particular session is over, you have to practice question 8 and question 9. Don't miss these. I am putting star mark here. Just normal questions only. Just practice them. Don't miss them. 8, 9 practice. Okay. Here itself you please write down. Or else a fresh page you take. Each chapter some questions I will give you. You practice them after this marathon session is over without fail. Okay. Question 8 and question 9. Solve it. That's it. Don't do except these. Don't unnecessarily waste time in dividends. That's it. Dividends chapter the maximum time that you have to spend. Dividends chapter maximum time that you have to spend is only 1 hour. That 1 hour over. Okay. Next. Let us go into the next chapter. Next area. Okay. See that. Let us go on into the next area called as capital structure theories. Capital structure theories. Open the study material. Okay. Okay. Before we go into capital structure theories, first point number 1. These are all the various formulae which you need to keep in mind. Okay. If these formulas you don't know, you are gone. Okay. You are gone. That's it. You are gone means this chapter gone in exam over if the question comes. So properly first see this formula, the summary of the chapter. Let us see. Okay. First, there are four very important formula in this chapter. The base of this entire chapter is based on four formulae. Let us see what they are. First one, company value B plus S. B means a debt, S means equity. Over. In that, B can be calculated as I by KD with the tax I into 1 minus T by KD. Next, S means value of equity. Value of equity. Value of equity. In this chapter, growth will not be considered. Therefore, whenever I say value of equity, sir, P not equal to D1 by KE minus G. Growth is not there means what? D0 only will be there. So, P not equal to D by KE. D means what? Dividend. Dividend will be paid out of what? Earnings. Okay. Dividend will be paid out of earnings. Therefore, in this chapter, the assumption is entire earnings will be paid as dividend. Therefore, earning available to equity shareholder divided by KE will become the value of equity. Okay. Value of equity. So, V equal to B plus S. B is I by KD. S is EASH divided by KE. Value of the company. Sir, already we calculated. Na? This is another way of calculating value of company. Okay. Simply you can see here. Four formulae. Four formulae. Please observe clearly. Please observe clearly. V equal to B plus S. B equal to I by KD. S equal to EAESH divided by KE. Instead of writing it as EAESH, EBIT into 1 minus T into 1 minus T. EBIT into 1 minus T. Technically, I wanted to tell this way, that is with the tax. EBIT minus I divided by KE. EBIT minus I divided by KE. So value of the company can be written as EBIT divided by KO. EBIT divided by KO. That's what I have given here. If taxation is also involved, instead of taking EBIT, you will be taking EBIT into 1 minus T whole divided by KE. So how this formula has to be understood? V equal to B plus S. B is I by KD plus S is EBIT minus I divided by KE. Combination I plus EBIT minus I, KD plus KE called as a KO. Minus I plus I cancel. So V equal to EBIT divided by KO. That's how this has to be understood. Clear? So therefore, V equal to B plus S. The value of the company is nothing but the value of the debt and value of equity. Value of debt is I into 1 by K, I by KD if it is without tax. With the tax, I into 1 minus T by KD. Next, value of equity, earnings available to equity shareholder. What is earning available to equity shareholder? EBIT minus I. EBIT minus I. So EBIT is the earning available to both equity and debt. In that interest portion, if you remove, remaining everything belongs to the equity shareholders. Okay. If taxation is also involved, then what you will do? If taxation is also involved, EBIT into 1 minus T minus I. Okay. Next, divided by K. And finally, V equal to EBIT by KO. Up to here, everyone understood clearly? Four formula, everyone understood? Everyone understood all the four formula given here? Reply. Those who are in live, okay, please stay in live consistently and complete the chapters. If you can complete as high as possible, okay, your burden of studying again will get reduced. Okay. Now, with regard to the next one, there is another calculation, value of the levered company, value of the levered company equal to value of unlevered company plus borrowings into tax, value of unlevered company plus borrowings into tax. Financial break-even point I plus preference dividend by 1 minus t. Preference dividend by 1 minus t. Financial indifference point. It is a level of EBIT at which EPS is same under any given alternatives. Okay, EPS is same under any two given alternatives is indifference point. EPS becomes zero in case of financial break-even point. Okay, I am putting this screen before you. First, mug up all the formulae. Classroom discussion we will spend around 20 videos are there in this chapter in the regular session. Okay, 20 into 2 or 2.5 hours means 50 hours we need to discuss on capital structure. That all I will discuss in 1 hour now. Not even 1 hour, 45 minutes I will try to complete. Means all the core important points, whatever you need to remember for the exam, we will do that. First, see all the points clearly. 1 to 7, 7 formulae are there, 7 concepts are there. 7 concepts if you know, that's it, nothing required. Same concept will repeat again and again in all the problems. 2 minutes time for every one of you. See all the 7 concepts. Once you complete, put an S there. If you say yes, it's an assumption that you completed. We'll start with the problem. Okay, yeah, keep the heading capital structure. Okay, let's begin. Capital structure, this is the concept. Okay, let us begin now. See here, with regard to the capital structure concept, let us take some questions and try to solve them. Okay, see here, we have taken capital structure theories, we are trying to solve them. First one, Aina Limited is considering a new project. Okay, please listen. Okay, so please listen carefully. Let's complete all the concepts. Practical questions, once we solve, then we will go into other questions also. Some important questions are also there, that also we will solve. Okay, let's begin. Aina Limited is considering a new project which requires a capital investment of 9 crores. Long-term loan rate is 12%, corporate tax 30%. Calculate the point of indifference for the project considering the debt equity ratio insisted by the financial agencies is 2:1. What do you mean 2:1? 2/3 is equity debt, 1/3 is the equity. Okay, let's read the question first. Anyone have the doubts also, you can put in the comments box. I will definitely answer. Okay, listen now. First, question is asked on indifference point. Question is asked on indifference point. From now, I will first read the question, I will explain, and then I will show you the answer directly. Listen carefully and observe that. Okay. First, Aina Limited is considering a new project which requires capital investment of 9 crore. 9 crore is the capital. In that, 2/3 is the debt, and 6 crore. 1/3 is the equity, means 3 crore. On this 6 crore, 12% interest will be charged. Okay. Corporate tax is 30%. Point of indifference for the project considering debt equity ratio is 2:1. Okay. Let's try to solve this first. Question number 1. Calculation of indifference point. Okay. Calculation of indifference point. Calculation of indifference point. Okay. Let us take the calculation of indifference point. How to calculate indifference point? Indifference point is a situation. It is. That's why I asked you first to have the clarity. Level of EBIT at which EPS is same under any two given alternatives. So, write down. Particulars. What he is asking? Point of indifference for the project. Considering the debt equity ratio insisted by financial agencies is how much? 2:1. 2:1. See here. First see here. First see here. Yeah. See here. Listen first. Try to understand clearly. As I already said, amount required is 9 crore. 6 crore will be the debt component. Interest will be 6 crore into 12%, 72 lakh. Okay. EBIT under both the options. See the answer clearly? EBIT will be assumed to be X. Okay. EBIT minus interest. That's what I have written here also. EBIT is a X. Okay. First option. Okay. Interest is not there. Sir, he did not say that. Whenever indifference question is asked in exam, he need not tell. First option will be all equity, means no debt. Second option will be equity plus debt. Okay. This is the option we have taken. This is the option already given in the question. Okay. Already given in the question. EBIT is X. Interest 72 lakh. Here interest will not be there. Option 1 is simply to tell all equity. This is equity as well as a debt. Two kinds of situations will be coming. Okay. So see here now. All equity. Since it is all equity, interest will not be there. EBT and EBIT both are same. Taxation at the rate of 30%. So X into 30%, 0.3x. EAT equal to 0.7x. Number of shares equal to 90 lakh. Number of shares equal to, number of shares is 90 lakh. Next, number of shares equal to 90 lakhs. Why 90 lakhs? Par value is assumed to be 10. Par value will be assumed to be 10. Total amount is 9 crore. When it is all equity, entire 9 crores will be capital is given by equity only. So 90 lakh shares are there. If debt is also there, 2/3 will be taken by debt. Only 1/3 will be equity. Therefore, 3 crores only equity. 3 crore divided by 10, 30 lakh shares only will be there. But interest charge will be there. So EBIT X, interest is 72 lakh. EBIT minus interest. So EBIT minus interest. Tax 0.3x into this much. EAT 0.7x minus 50 lakh 40,000. Okay. Now equate both of them. How much is the X is the financial indifference point. Okay. See here. Option 1, EPS equal to this much. Option 2, EPS is this much. Equating both of them will be the common EBIT. So 0.7x by 90 into, equal to 0.7x minus 50.4 divided by 30. Finally, the x came to 1 crore 8 lakh. EBIT, if it is 1 crore 8 lakh, at this level of EBIT, whether your company is financed by all equity or financed by debt equity, your answer will be same. Okay. Everyone answer, did you understand this question or not? First question, did you understand or not, everyone? Everyone answer. Yes or no? Understood this question or not? So this question is based on financial break even, financial indifference point. Whenever indifference point question comes, two things you need to remember. EBIT we don't know. Okay, EBIT we don't know. At that EBIT, EPS under both the options will be same. So we need to calculate EBIT keeping it as a X amount. Number one. Number two, if we clearly say okay, if we did not say anything, if one option like debt equity they have given, other option is all equity. Like that comparison should be made. Okay, question 1 over. Question 2. Xylo Limited is considering two alternative financing plans as follows. Equity shares of rupees 10 each, 8 lakhs and 8 lakh. So 80,000 shares, 80,000 shares. Preference shares 100 each, not there in the plan A, is there in plan B. So technically 4,000 preference shares. 12% debentures, here debentures are there, here preference shares are, debentures are not there. 12 lakh and 12 lakh. Simply to tell, total capital 12 lakh. First option equity debt option, second option is equity preference option, equity preference option. The indifference point between the plans is 4 lakh 80. Corporate tax rate is 30%. Calculate the rate of dividend on preference shares. Here he is not asking about, financial indifference point. Indifference EBIT he has only given 4 lakh 80. What he is asking? He is asking calculate the rate of preference dividend. Rate of preference dividend. Preference shares given. How much percent preference shares these are? 5% or 10% or 20% preference shares are 10, 12% preference. That's what he is asking in the question. Okay. Read the question properly first before we go with a common solution. If you follow live properly, you will complete directly. Unnecessarily, don't skip the live. 2 minutes time. Read the question first. Okay. Shall we continue, everyone? Shall we continue, everyone? Okay. See here. Second question. See here. It is given that indifference is achieved at 4 lakh 80. Therefore, EBIT is 4 lakh 80. Already I said that. Rate of preference dividend will be calculated as a percentage. First option, plan A, equity and debt option. Second option, equity and preference. Okay. EBIT 4 lakh 80, 4 lakh 80. First option is equity and debt. Debt carries a interest. Okay. How much is the debt? How much is the debt? 4 lakh into 12%. Take calculator. 4 lakh into 12%, 48,000. So 48,000 deducted. EBT is 4 lakh 32. Tax 30% deducted, EAT. Preference dividend not there, EAESH is this much. Number of shares is 80,000. and EPS is 3.78. One clarity came. Okay, next. So EPS this much. Next, equity and preference shares. EBIT 480 even in that option. Okay, interest will not be there because preference shares will have dividend. It's an appropriation out of profit. It's not a charge. So interest is not there. EBT 480. Tax this much. EAT is 3,36,000. From this EAT, we need to reduce the preference dividend. How much? We don't know. Okay, but we know one thing. 4,80,000 is a financial indifference point. At this level, EPSs will be matching together. So 3,36,000 minus X divided by 80,000. This is EPS under option 2. This is EPS under option 1. Both will be same because EBIT is indifferent. So therefore, 3.78 equal to this much. You multiply X equal to 33,600. What is X here? Preference dividend. Preference dividend 33,600 on a total capital of how much? 4 lakh. Means how much is the rate? 8.4%. That's how the answer is calculated. Everyone answer? Understood the calculation clearly or not? Like this, I will solve all the questions. I will show if there is any important calculation, I will do. If the important calculation is not there, just only reference is there, we will do the reference and we will go to the next one. And listen again, the questions which we are doing in the marathon, now the chapters which you are doing in the marathon and completing, these chapters again you should not do. Either first, either last. Again, if you do, you are killing your time. I am telling you very clearly. That's why I am telling you, do along with me now. Again and again, you will not get the time. If you sit yourself now, you will sleep. Do along with me. Once you complete here, that's it. Again, you will not see the capital structure chapter. If you want, day after tomorrow, morning time when time is available, do RTP. That's it. Listening? Do along with me now. If you do, that's it. Again, dividend chapter again you should not touch. Capital structure again you should not touch. Either first, either last. Shall we go to the next one? Okay, let's begin. Okay. Next, question number 3. Ganesha Limited is setting up a project with a capital outlay of 60 lakh. It has two alternatives in financing the project. Alternative 1, 100% equity finance, 10 rupees each. Debt equity 2:1, 10 rupees each. Rate of interest payable is 18%. Corporate tax is 40. Calculate indifference point between two alternative methods of financing. Okay. So tell me how to do the question first. How to do the question? I will tell. First, EBIT is given or not given? Not given. Not given. Means EBIT, if not given, what to do? Put it X. EBIT. First option is 100% finance. Interest will not be there. Second option, equity and debt. Interest will be there. So therefore, interest is how much? 18%. Interest is how much? 18%. Just we need to compare both of them and calculate. First option, entire 60 lakhs. And 6 lakh shares will be there. Okay. Second option, 2:1. 6 lakh into, 60 lakh into 2/3. 40 lakhs will be raised by debt. 20 lakhs only will be raised by equity. 20 lakh divided by 10. 2 lakh shares will be there in the second option. So 6 lakh shares, so 2 lakh shares calculation. Everyone tell me understood or not? 6 lakh shares, so 2 lakh shares calculation. Everyone understood or not? Okay. Remaining everything I will show you. See here. First, EBIT we don't know. Okay. EBIT we don't know. Interest. First option interest will not be there. Second option 60 lakh into 2/3 into 18%. 7,20,000 interest. EBIT will be X. Here this is understandable. This one X into X minus 7,20,000. X minus 7,20,000 tax. 40% of X is 0.4X. 7,20,000 40%, 2,88,000. So X minus 0.4X, 0.6X. 7,20,000 minus 2,88,000, 4,32,000. That too only for 2 lakh shares. So therefore, This and this will be equated. Upon equating, we got answer as 10,80,000. What is 10,80,000? This is the EBIT at which whether you finance with equity or with the 2:1 debt, EPS will be same. Everyone answer understood this question number 3 or not? Your idleness can never become an answer. Your silence never is an answer. Reply. We completed 3 questions now. Okay. Next. Number 4. Ganapati Limited is considered, this question market important for the coming J25 exam, day after tomorrow. This question can directly come in exam. Even after telling that it will directly come in exam, if you sleep, na, God also can't save you. Okay. So, let us understand what is the importance of this question. This question has one uniqueness. That uniqueness I will tell you once we read. Ganapati Limited is considering 3 financing plans. Key information is as follows. Total investment 2 lakh. Okay. Total investment 2 lakh. Plans of financing. Okay. 100% plan A, 100% equity. Like this you need to read. Not like this. Okay. Horizontally you should read the data. First option 100% equity. Second option debt to equity. Third option preference equity. Cost of debt 8, cost of preference 8, tax rate 30%, 50%. Equity shares face value 10 and will be issued at a premium of rupees 10. Issued at a premium of 10. Premium is 10. Face value some amount. Face value 10. Premium 10. So issue price will be 20. Expected EBIT 80,000. You are required to determine EPS. Financial break-even point. Indicate if any of the plans dominate and compute the EBIT range among the plans of indifference. Very, very important question for the exam. First, read the question properly before we go into the calculations. Read the question. Read the question. So you need to read the question for the different financing proportions. Equity, equity debt, equity preference. Read the question. Read the question. Okay. Listen now. What is the importance of this particular question? Okay. What sort of importance this question has? Let's have a clarity first. Okay. What is the importance of this question? First point, total investment is 2 lakh. Financing proportions are given. First financing proportion is equity. Second financing proportion is equity and debt. Third financing is equity and preference. In all these, one thing is common. Equity is there everywhere. Okay. Without owner's fund, projects cannot be started in any company. One is equity debt, another one is equity preference. Okay. Cost of debt, cost of preference given, tax rate is given. Equity share face value 10 and premium is 10. 20 rupees is the issue price. EBIT 80,000. Determine for each plan earnings per share. Okay. Earnings per share. Earnings per share means how to calculate here? Only equity, equity and debt, equity and preference. If you take like this, EBIT under 3 options, how much? 80,000, 80,000, 80,000. Minus interest. First option, 2 lakhs is the investment. In this 2 lakh, 50% debt means 1 lakh. That 1 lakh into what is the cost of debt? 8%. Okay. minus 8,000. Here it will not be there. Next, EBIT minus interest is EBT. 80,000, 72,000, 80,000 minus tax. Tax is 50%. 40,000. Okay. 36,000. 40,000. So EAT 40,000, 36,000, 40,000 minus preference dividend. Preference dividend 8%. 8% of 1 lakh. 8,000. So earnings available to equity shareholder 40,000, 36,000, 32,000. Number of shares. Number of shares. How many number of shares will be there? I am writing here. Number of shares. Totally first option lo 2 lakhs will be raised by 20 rupees. So 10,000 shares. Okay. 2 lakhs will be issued not at 10 rupees. At 20 rupees they are issuing. 2 lakhs divided by 20, 10,000 shares. Next. Second option, equity and debt. 1 lakh will be raised by equity divided by 20. 5,000 shares. 5,000 shares. Next one also 5,000 shares. EPS 4, 36 by 5. 7.2. 32 divided by 5. 6.4. 4, 7.2 and 6.4. Which question? Fourth. 4, 7.2 and 6.4. Everyone understood the first query clearly or not? It's not just like saying yes, everyone really understood the point. How we got this answer? Okay. So one work is over now. So first bit completed. Next, financial break-even point. Okay. Interest plus preference dividend by 1 minus T. Interest. Okay. Interest. 1 lakh into 8%, 8,000 divided by preference dividend 8,000 divided by 1 minus 0.5. 8,000 plus 8,000 divided by 0.5. 16,000. So total it will be 24,000. Bit number 2 answer. Which question we are doing? Question number 4. Okay. Financial break-even point. First case la financial break-even point has no meaning. Okay. No meaning. Second question la financial break-even point concept is only interest. If it is all equity, I plus PD by 1 minus T. I will not be there, PD by 1 minus T will not be there. Therefore, it is 0. In the second option, I plus PD by 1 minus T. Okay, I plus PD by 1 minus T. What is the I? Interest is 8,000 plus PD is 0. So, therefore, 8,000 will be the answer. Okay, if only debt is raised, only preference is raised. Okay, assume that debt is not there. In that case, interest is 0. PD is 8,000 divided by 1 minus 0.5. So, total it comes to 16,000. Comes to 16,000. That's it. Second calculation is also done. Indicate if any of the plans dominate and compute the EBIT range among the plans for indifference. Among the plans for indifference. Whenever indifference has to be calculated, listen carefully to this concept. Okay. Whenever indifference has to be calculated, I have given the notes also here. Whenever indifference has to be calculated, see, indicate if any of the plans dominate and compute EBIT range among the plans for indifference. There are 3 plans totally. A, B, C. What are the combinations possible? AB combination, BC combination, AC combination. AC combination. AB combination understood. Okay, AB combination, equity and debt. Next combination, debt preference. Next combination, equity and preference. These are the various options that are available. Correct or not? So see here. Plan A and B. Plan A and B. Plan A and B. A is equity, all equity, and B will be debt. B will be debt and equity. All equity, same calculation. Here in the second case, debt will be there. If you equate, it came to 16,000. This is like all the previous questions. Okay. Next. Combination A, B, C, you keep it away. Combination A, C, you see. A is talking about this one. C is talking about preference dividend. Equate both of them. We got 32,000. You compare equity and debt indifference. You compare equity and preference indifference. Understandable. But debt preference key indifference cannot be calculated because as an equity itself is not involved. What is not involved? Equity is not involved. If you take only debt preference, comparison itself will become wrong. Reason I will tell you. EPS will be calculated. EPS is calculated for whom? What is an indifference point? Indifference point is a situation where the EBIT where EPS will be same. EPS will be same. You are saying equity shares not there. Debt and preference is only there. When debt and preference is only there, when shares are not there, concept of this indifference point do not arise because at the end of the day, our calculation is EPS. Earnings per share. Of the shares are not there means why you are calculating earnings per share? Therefore, debt to preference combination indifference point concept does not apply. Therefore, you need not do anything in examination. Just you keep a answer that plans are incomparable. Plans are incomparable. You cannot compare those plans at all. Which two plans? You cannot compare debt and preference plan. Reason, earnings per equity share we will calculate. When earnings per share question will come, when the shares are there. You are telling that debt and preference is only there. When debt and preference is there, equity shares are not there. What is not there? Equity shares are not. Then EPS calculation is irrelevant. When EPS calculation is irrelevant, indifference point concept is irrelevant. Okay, that's why those are incomparable. Next. Sir, everyone answer. Understood point 1, point 2, point 3 clearly. Yeah, everyone. Everyone understood or not? Question number 5. Yo-Yo Limited presently has 36 lakh in debt outstanding, bearing an interest rate of 10. It wishes to finance 40 lakh for expansion program and considering three alternatives. So it has 36 lakhs in debt presently and it wishes to finance 40 lakh expansion program. It wanted to raise extra 40 lakh. There are three alternatives. Additional debt at 12%, additional debt at 12%, preference shares with 11%, and issue of equity shares at 16%. Company presently has 8 lakh shares outstanding and is in a 40% tax bracket. If the earnings before interest and taxes presently are 15 lakh, determine the EPS for the three alternatives, assuming no immediate increase in profitability. Analyze which alternative would you prefer. Compute how much would EBIT need to increase before next alternative would be the best. Second bit we can do later. First you answer the bit number 1. See the question first. Okay. Let us first understand what are all the alternatives. Alternative number 1. Alternative number 1. This 40 lakhs is raised by debt with the 12% interest. This 40 lakhs is raised by preference with 11% dividend. Or if it is issued as a equity shares with 16 rupees. Presently, the company has 8 lakh shares outstanding and is in 40% tax bracket. Earnings before interest and tax is 15 lakh. First, don't do unnecessarily. Let us not waste time. Let's do more questions rather than doing and wasting the time. Okay. Let me first explain you the main point clearly. Point number one. Whenever we are talking about this, this question is called as various plans comparison. Capital structure theories. This is the capital structure planning. Three different plans are there. Already in my company, 8 lakh shares are there. How many lakh shares here? 8 lakh shares are there. Okay. In my company, already 8 lakh shares are there, and already present 36 lakh debt is there in the company. Okay. That is having 10% rate. New debt will carry 12% rate of interest. New debt will carry 12% rate of interest. So first tell me, if the company finances the project, under three alternatives he said, na? First alternative is what? First alternative will be the equity issue. Second alternative will be preference issue. Third alternative will be the debt issue. Fifth question. See here. Option 1, only debt. Option 2, only preference. Option 3, only equity. Option 1, only debt, only preference, only equity. If you go by only debt, EBIT 15 lakh, already existing 36 lakh debt at 10%, 3 lakh 60, new issue become 4 lakh 80. Why 4 lakh 80? You will raise that 40 lakhs. Okay, you will raise that 40 lakhs at how much percent rate? At the rate of 12% into 12%. 4 lakh 80,000. 3 lakh 60, 4 lakh 80, 8 lakh 40,000. EBAT 6 lakh 60, tax 40%, EAT, preference dividend will not be there. Earnings available to equity shareholder 3 lakh 96, number of shares is 8 lakh, EPS is 0.495. Only preference if you take, EBAT you have taken, okay, EBAT you have taken, existing debt 3 lakh 60 is already there, for 11 lakh 40,000, taxation, EAT, preference dividend you will deduct now, and here it came to 0.305. Only equity model if you go, 15 lakh, no extra interest on the 36 lakh 10%, 3 lakh 60. So totally the EBT 11 lakh 40, tax rate you remove, EAT divided by number of shares. Number of shares is how much? 10 lakh 50. How you got the 10 lakh 50? Existing shares 8 lakh already there. New issue 16 rupees ka I need to issue. 40 lakh divided by 16, 2 lakh 50. Totally 10 lakh 50,000 shares are there. Okay. Next. So earnings before interest and tax presently are 15 lakh. Calculate EPS. So tell me, what is the EPS? 15 lakhs we have taken EBIT in all the cases. What is the EPS? 0.495, 0.305, 0.651. Next. Analyze which alternative do you prefer. Whichever give more EPS, we will prefer that model. Who gave the more EPS? More EPS is given by alternative 3. Next. Determine EPS under all the three alternatives, assuming that no immediate increase in profitability. Next. Analyze which alternative do you prefer. Compute how much would EBIT need to increase before next alternative would be the best. Simply is asking calculate the indifference point. Calculate the indifference point. Indifference point means again EBIT X. Okay, we have to calculate. We are having equity only, debt only, preference only. Equity and preference you can consider. Equity, debt you can consider. Debt and preference can't be calculated. See here what is saying. Analyze which alternative would you prefer. Compute how much would the EBIT need to increase before next alternative would be best. Okay. So option 1, debt. Option 3, only equity. So EBIT X, interest we have taken, EBT calculated, tax, EAT, number of shares. Equate both of them, EBIT comes to 23,76,000. 23,76,000. What is this 23,76,000? This is the EBIT at which, okay, this is the EBIT at which EPS under both the alternatives will be same. So this is the question that is being asked. Analyze which alternative would you prefer. Analyze which alternative would you prefer. So obviously which alternative will I prefer? First, best alternative is equity. Second best alternative is debt. So go for debt and equity alternative. That's why option 1 debt, option 3 only equity. That's why preference alternative itself is not taken. So debt ki equity ke we have taken. If only if debt is there, how it look like, and if it is financed by equity, how it look like. Both the alternatives we have done. Understood why we have taken only option 1 and 3, why we have not taken 1 2 2 3 concept. Here is asking choose the best alternative. What is the best in terms of EPS? Only equity consider. Next one debt. Next one debt. So therefore do it for only equity, do it for only debt. Preference don't consider because best alternatives that will not come. Okay, this is the calculation part you can do later. Just you need to understand the query first. Okay, next question number 6. Alpha Limited requires funds amounting to rupees 80 lakhs for its new project. To raise the funds, company has two alternatives: to issue equity shares of rupees 100 each at par amounting to 60 lakh and borrow the balance amount at interest at the rate of 12% per annum, or to issue equity shares of rupees 100 each at par, 12% debentures in equal proportion, income tax is 30. Identify the indifference point available under both the alternatives. Okay, you do one thing. 2 minutes time I will give. Take a pen, paper, do this answer and complete, such that you need not again do indifference point calculation. This is the first, this is the last. Everyone in live, I should not see anyone leaving the live. Please do it. Question number 6. Indifference point, take a pen, paper, calculator. Roughly you do the calculation and tell me what is the EBIT answer. Okay. First alternative is what? To issue equity shares of rupees 100 each. Okay. Next, to issue equity shares of 100 each and 12% debentures also in equal proportion. First option 100% equity. Second option 50-50 equity debt. Everyone please calculate and tell me what is the answer for indifference amount of EBIT. I should not see anyone leaving the live. Okay. Mark my words. If you are in live, you will get fantastic marks. Okay. So please don't leave the live. Sit, do it. Small amount of determination also you will not have, at least a day before exam. Do it. Question number 6. You should be well determined. Yeah, it is your examination. Okay, today I started my class at morning 7 till evening 8 o'clock. I have class. Again I sat. I will also feel sleepy, but still things are more important than our sleep. Solve it. I will wait for you. Solve question number 6. And moreover, tomorrow also I will come live. Okay, my target is out of 6 important chapters, 4 chapters I will complete. Okay, tomorrow I will tell you what to do, and again I will come up live like this. 9 to 12 o'clock I will come live again tomorrow. Tomorrow also I will come live. There again 2 chapters we will do. My target is I should be covering at least 4 important chapters in your syllabus. Okay, remaining 2 chapters you do. 4 chapters I will do. We will do together. Okay, such that burden will be shared. Tomorrow what to do also I will tell at the end of the live. I will tell you what to do in the tomorrow session. So before we close the live for today, I will first tell what to do in the next class. I mean for the next one day what you have to do. Before asking any question in the YouTube live, I want every one of you do this answer first. Only equity and debt. Do the calculation. Okay. Yeah. Enough time taken. So everyone have given the answer as 9,60,000. 9,60,000. So sixth question, perfect answer is 9,60,000. So sixth question, 9,60,000. Okay. Next. So I want only to do up to there. If you understand up to there, it's more than enough for the examinations. Next. Sir, before we go into any other question, okay, before we go into any other question, see here. Come to question number 10. Question number 10. Once question number 10 is also completed, once question number 10 completed, then we will be going into the capital structure theories. Now capital structure planning only completed with this. Then we will be going into the capital structure theories. In that, net income approach, net operating income approach, Modigliani-Miller approach is there. Okay. Those are the three theories that we need to learn. Okay. What is that? Net income approach, net operating income approach, net income approach, net operating income approach, Modigliani-Miller approach. Three approaches are there. Okay. I will show you three questions on those. How many? Three questions I will show you. Once you understand those three questions, enough, any question that comes in exam, you will be able to solve. Okay. Let us do 10 question first. Axar Limited has sales of 68 lakh, variable cost is 60%. Variable cost is 60%. Company has a fixed cost of 16 lakh 32,000. Capital of the company consisting of 12% long-term debt, 1 lakh preference shares of rupees 10 each, carrying a dividend of 10% and 1 lakh 50,000 equity shares. Tax rate applicable to the company 30%. At the current sales level, determine the interest, EPS and amount of debt for the firm if a 25% decline in sales will wipe out all the EPS. Very, 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 very important question. Read the question first before we go into solution. Read the question first. Question number 10. Okay. So Axar Limited has a sales of 68 lakh. Variable cost ratio is 60%, means PV ratio 60%. So variable cost is 60% of 68 lakhs. Okay. Next, company fixed cost 16 lakh 32,000 is the fixed cost to the company. Capital comprises of 12% long-term debt, 1 lakh preference shares of 10 each carrying a dividend, 1 lakh 50,000 equity shares. That is the capital structure of the company. Okay. Next, after that, tax rate is 30%. At the current sales level, determine the interest, determine the EPS and the amount of debt for the firm. If 25% decline in sales will wipe out all the EPS. Will wipe out all the EPS. See here. Okay. Listen first. I will explain. This is not time to do the problem. Lot of time will be taken. So therefore, I will first explain and I will close it. Okay. Okay. Now, see here. First point number 1. What is the first question is asking? At the current sales level, determine the interest, EPS, amount of debt. Okay. See here. First, calculation of EBIT at current level of sales. Calculation of EBIT at the current level of sales. Sales 68 lakh, variable cost we removed, contribution, fixed cost, EBIT. Okay. Next, what he is asking? He is asking calculate interest, okay, interest at the current sales level, determine interest, EPS and amount of debt, okay. For the firm, if there is a 25% decline in sales, will wipe out all the EPS, okay. At the current sales level, determine interest, EPS and amount of debt for the firm. If 25% decline in sales will wipe out all the EPS. So first we calculated EBIT, okay. Calculation of EBIT if sales decline by 25%. Sales decline by 25%, mean take calculator, 68 lakh minus 25%, 51 lakh, sorry, 51 lakh. But the amount of variable cost also will reduce simultaneously. 51 lakh into 60%, 30 lakh 60,000, contribution is 20 lakh 40. Okay. But fixed cost will not change. EBIT becomes how much? 4 lakh 8,000. Calculation of interest cost if the sales decline by 25. It is given that if the sales decline by 25, EPS will be 0. Okay. So 25% fall in sales makes EPS as 0. Hence we make reverse calculation. EPS 0. EPS 0. EBIT is how much? 4 lakh 8,000. So observation required. See here. EBIT 4 lakh 8,000. EPS 0. EPS 0. Already we know that there are 1,50,000 equity shares. Okay. EPS 0 means earnings is 0. So 0. Preference shareholders already we raised. How much amount from the preference shares? See here. 1 lakh preference shares of rupees 10 each. Dividend is 10%. So 10% of 1 lakh, how much? 10,000. Preference dividend is there. How much? Preference dividend is there. EAT, how much? 10,000. Okay. 10,000 is the 70% value. Okay. How much value? 70% value. So see here. EBIT 4 lakh 8,000. Okay. If there is a 25% decline, it wipes out all EPS. Means EPS will become 0. We know that number of shares are 1,50,000. Okay. But this is 0 means earnings is 0. Earnings is 0. But preference dividend we have to pay. How much? 10,000. How much? 10,000. After paying the preference dividend, EISH became 0. Means EAT is exactly how much? 10,000. How much? 10,000. Now the question. Please listen carefully to this. Important. This 10,000 is equal to 70%. Is equal to 70%. Tax rate at the rate of 30%. EBT will be 14,286. If this is 70%, how much is 100% is a calculation. Okay. 10,000 into 100 divided by 70. That came to 14,286. So interest taxation is 4286. EBIT will be 14,286. EBIT is the 4,08,000. EBT is the 14,286. Balance is the interest, which is 393,714. 393,714. You are paying interest on how much debt? See here. On how much debt? 1 lakh preference shares are there carrying the dividend rate. Okay. On how much debt you are taking? Interest, EPS, amount of debt. Okay. That's why, see, interest is 3,93,787. Interest is 3,93,787. 3,93,714. So therefore we calculated interest now. At that level you calculated the EPS as 0. Calculation of EPS at the current sales level. Current sales level it is how much? 3.173. EBIT 10,88,000. 10,88,000 already we calculated here. EBIT 12,88,000. Interest cost we calculated. EBIT, the EBT, tax, EAT, preference dividend, everything is done. 3.173. Calculation of amount of debt. Amount of debt. Interest percentage equal to interest by debt. Interest percentage already we know 12%. Interest amount already we know 3,93,714. So debt is how much? 32,80,950 rupees. This is how we need to calculate this particular question. Okay. So please see this question one more time. Important question. Let's read. One last time I will read it for you. Please see here. Axar Limited has a sales of 68 lakh. Variable cost 60%. Company has a fixed cost of 16 lakh 32. Capital is 12% long-term debt. Interest rate 12%. Next, 1 lakh preference shares of rupees 10 each. Dividend rate is 10%. 1 lakh 50,000 equity shares. Tax rate 30. At the current sales level, determine interest, EPS and amount of debt. Okay. Next, and the amount of debt for the firm, if 25% decline in sales, will wipe out all the EPS. Will wipe out all the EPS. First, at the current sales level, interest to EPS amount of debt, if there is a 25% decline in sales. If there is a 25% decline in sales, if there is a 25% decline in sales, EPS will be 0. So on that basis, if you calculate, you got this 3,93,714 as a interest as a balancing figure. Okay. If interest is 393,714, then the EPS will become how much? 0. So calculation of EPS at the current sales level. If there is a decline, then it will be 0. At the current sales level, what is the EPS? Current sales level, EBIT is 10 lakh 88. If you calculate, EPS is 3.173. What is the amount of debt here? Amount of debt is 3,93,714 is 12%. So divided by 12% is 32,80,950 is the amount of debt. So across any level of sales, interest cost will remain the same. Therefore, at normal level or 25% declines level, interest cost remains the same. Preference dividend 1 lakh into 10%, 10,000. Okay. Sir, everyone understood this question clearly? Everyone? Everyone understood this question clearly? Okay. Okay. These are all some important questions that you need to do in this chapter called as capital structure theories. Next, there are 3 kinds of theories. First theory, net income approach. Second theory, net operating income approach. Third theory, Modigliani-Miller approach. First theory is what? Net income approach. Next one, net operating income approach. Third one is Modigliani-Miller approach. I will show it from the notes directly. Please listen carefully. Okay. See here. First, where is it? Net income approach. First one, listen carefully. Every student, please listen carefully first. Once after listening to the discussion, problem solving becomes very, very easy. Listen. Net income approach says that. Net income approach says that as the company has more debt in the capital structure, as the company has more debt in the capital structure, the value of the company will be more. Means what? It says that debt in the capital structure will necessarily affect the value of the company. How they prove that? Listen carefully. Net income approach says that as more debt is there in the capital structure, more debt is there in the capital structure, debt amount, always remember KE will be more than KD. KE will be more than KD. Simply in a reverse way, how to tell? KD is always cheaper than KE. KD is always cheaper than KE. Net income approach says that. Repeat. Net income approach says that KD is always lesser than KE. Therefore, having more debt in the capital structure will lead to lesser KO. Will lead to lesser KO. Higher equity, lower debt, higher KO. Okay. Higher debt, lower equity, lower KO. Lower the KO, higher the value of the company. Higher the value of the company. Take calculator. 100 rupees is the value of 100 rupees is the EBIT. 100 rupees is the EBIT. Say for example, divided by KO 10%. Divided by 10%. What is the value of the company? 1000. Reverse now. 100 divided by, let us say KO is 8% divided by 8%, 1250. From this, what you have to understand, as the KO is reducing, value of the company will increase. When KO will reduce? When KO will reduce? When the overall KD is more. Simply KD is not more. Debt component is more. Automatically equity component will be lesser. When equity component is lesser, simply to tell this way it will occur. See, two options I will tell you. Okay, two options I will tell you. 70% equity, 30% debt. 30% equity, 70% debt. Okay. KE 10%, KD 5%. Let's take an example. Okay. KO equal to WD KD plus WE KE. WD, how much? 0.3, KD 5. WE 0.7, KD 10. Okay. 1.5 plus 7, how much? 8.5%. This is the KO. Second case, 70% equity and 30% equity and 70% debt. Okay, WD 0.7 into KD 5 plus WE 0.3 into KE 10. 0.7 into 5, 3.5 plus 3, 6.5%. So in the first case, KO is 8.5. In the second case, KO is 6.5. Okay. So always when the KO is lesser, value of the firm will be more. Therefore, what net income approach says, what the net income approach says is, net income approach says that, okay, as the debt component is more in a company, value of the company will also increase, because more debt, okay, more debt, lower the KO. Lower the KO, higher the value of company. This is what said by net income approach. Okay, reverse. Net operating income approach says like this. Okay, net operating income approach says that as the amount of debt is increasing in the company, KO will fall. However, as the amount of debt is increasing in the company, burden of insolvency or burden of payment of interest, okay, higher interest will be falling on equity. Therefore, equity will feel more burdensome, because entire earnings before interest and tax EBIT is eaten away by the debt holders in the form of interest. As the amount of debt is increasing, interest burden will increase. When interest burden is more, EPS will reduce. So who is taking risk? Equity. Listen again. Listen again. What net income approach says? More debt, lower KO. Lower KO, higher value of company. Who says? Net income. Net operating income says, yes, correct. As the debt is increasing, KO will reduce. KO reduce, value will increase. This is one effect. There is a double effect. Second effect you forgot. In the net income, net operating income said that you forgot another impact. I will tell that impact he said. What they said? Debt increases, KO reduces. KO reduces, value increases. This is one effect. Corresponding another effect is there. Second effect is, as more debt, risk to the equity is increasing. Therefore, they will ask more KE. They will ask more KE. More KE, more KO. So on one hand, KO is reduced and value increase. On the other hand, KO is increased, value will fall. This increase in value and decrease in value both will offset each other. Value of the company will remain the same. Value of the company will remain the same. Who said this? Net operating income said this. Okay. So summary of entire thing. As per net income approach, value of two companies will not be same. Okay, companies having more debt will have more value, companies having less debt will have less value. Net operating income says that whether you finance by equity, whether you finance by debt, no problem, both the companies will have same value. Who says this? Net operating income. That's why if a question comes to you in exam relating to net income approach, okay, net income approach, okay, what is your assumption? KE under both the options is same. KE under both the options is same. Understood the point? KE under both the options is same. But value of the companies will change. Value of the companies will change. Net operating income approach, when you do, value of two companies will be taken as same first. We will calculate KE accordingly. So, in net income approach, listen to my words. In net income approach, missing figure will be KO and value of the firm. KO and value of the firm. In case of net operating income approach, okay, KE will be the missing figure. KE will be the missing figure. Net operating income la KE missing figure. Net income approach la KO and value of the company are missing figures. Okay. Let us do two questions on this. Then you will only get the clarity. See here. Comprehensive example. EBIT 3 lakh, 3 lakh. Debt 9 lakh. KD 10. KE 15. KO 15. Okay. KO 15. Company J, company M. Company J is a equity and debt. Company M is all equity. Debt is not there. When all equity, KA, KO. KA, KO. So all equity, KE and KO both are same. So KE 15, KO is also 15. Okay. We are doing which approach? Net income. As per net income approach, what are the missing figures? KO is a missing figure. Value of the company is a missing figure. Okay. So, what is the assumption of all these models? We are taking two companies which are same in all the respects. EBIT, everything is same. One is financed by debt equity and the one is financed by equity. That's the only change. Okay. There are two identical companies which are same in all the respects except for their capital structure. Okay. Two companies, JM. What is the EBIT? 3 lakh and 3 lakh. Okay. 3 lakh taken. First, one company is having a debt, another company is not having a debt. That's it. Okay. Financing a different, remaining everything same. But M, only equity na, KE and KO both are same. KE and KO both are same. So, rearranging information for NI model. Okay. So, KE of two companies is assumed as same. KE of two companies is assumed as same. Because both the companies are similar in all the aspects. So, this is the point. So, first, how to do? EBIT, 3 lakh, 3 lakh. Interest, EBT, tax, nothing. So, EAT. Up to here understood. Okay, up to here understood. In both the options, what is same? KE is same. 15, 15. 15, 15. Already at the beginning, we saw four formulae. V equal to B plus S, B equal to I by KD, S equal to EAESH by KE. EAESH by KE. So, 2 lakh 10,000 divided by 15%. 14 lakh. 3 lakh divided by 15%. 20 lakh. Okay. So, this is S. In this company, debt is also there. Na? Debt also added. So, totally this much. V. 20 lakh, 23 lakh, 20 lakh. KO will be KO. We calculated already like this. Okay. In the previous example, what I told you. Value equal to EBIT divided by KO. Okay, I shown now first formula. I plus EBIT minus I will cancel EBIT by KO. So when KO you want, it is nothing but EBIT by V. EBIT by V. So EBIT is how much here? 3 lakh. Divided by V, 20 lakh. Okay, divided by 20 lakh. That is one model. And here it is. V equal to B plus S. V equal to B plus S. How much? 23 lakh. Okay. EBIT 3 lakh. So 3 lakh divided by 23 lakh. How much? 13.04%. 13.04. This is calculated under which model? Net income approach. What I said? Net income approach like KE will be same. KO will change. Value of company will change. Companies having debt will have more value. Company having debt will have more value. Okay. Same question if they ask on net operating income approach, your reply will change. Net operating income approach, what they said, two companies will have same value irrespective of debt equity. Therefore, first we will calculate value under one company. Same value we will take. So, therefore, EBIT 3 lakh and 3 lakh. Interest we will deduct. EBT we calculated. Up to here, both the options are same. Both the options same. KO will be same in both the options. Under net operating income, KO will be same. So 15 and 15. 15 and 15. KO will be taken as same. KO will be taken as same. So KO will not change. 15 and 15. So 20 lakh, 20 lakh. S equal to V minus B. So this is how we calculate it. Okay. Just you need to spend some time and do the calculation on net operating income approach. Simply, I can tell only one conclusion very quickly. Okay. One conclusion very quickly. Please listen carefully. Point number 1. Net income approach. Net income approach. Simple logic. KE is same for both the companies. KO will change. Value will change. Net operating income approach. Value will be same. That's why we will first take the value as same. Value will be same. Okay. What will change? KE will change. That's why missing figure is KE here. Okay. Missing figure is KE here. Value will be same. Value will be same. KO will be same. Why KO will be same? Just now I told na, more KD, more debt, lesser KO. Okay. Higher KE, more KO. So lower KO, higher KO offsets each other. KO will be constant. Since KO is constant in net operating income, value of the company also will stay constant. Understood? So these are all the points that you need to understand. Okay. So Modigliani-Miller approach only. Modigliani-Miller approach on capital structures I will discuss in the tomorrow's live. Okay. Tomorrow's live I will be covering out another 2 areas. Okay. Number 1 is the cost of capital and number 2 will be the areas relating to the ratios. Related to ratio. Okay. If time permits, I will also consider the concept of working capital. Overall working capital estimates concept I will explain very fast and I will close. Ratios chapter, how to do all the questions, the important questions in the ratios chapter I will do. Because tomorrow morning again 6 o'clock I am having a live for CA final AFM. So I need to take a nap and I need to start again. So whatever the time permitted, I try to complete it 2 very important areas, such that the day on which you completed your audit examination itself, you completed 2 very important chapters. One is the dividends, another one is a capital structure. I will tell you how to prepare for the tomorrow's preparation. First, let us say you started your day at 7 o'clock. Okay, be optimistic. Don't unnecessarily go to the extremes. I will wake up at 4 o'clock. Be optimistic. 7 o'clock you started, means you wake up at 6 o'clock, you completed all things, and 7 o'clock you started. Okay, from 7, okay, from 7 till 9, you have to complete, okay, you have to complete net income, net operating income approaches from the notes I gave you. Okay, from the notes and from the study material, do the questions first. 7 to 9, you should complete capital structure. Okay, capital structure, these questions. Plus, in the 2 hours time, you should complete leverages chapter. Study material, practical questions are there. There are around 7, 8, 9 practical questions. Only do those practical questions. Don't unnecessarily go to other questions. Okay. My notes is there in the Telegram group. If you want, you can search that. You can get it. So target 2 hours you have to complete. Not 2, 7 to 10. Complete capital structure and leverages. Okay. From 10:30 to 1:30, do your SM. Okay. Again from 2 o'clock to 5 o'clock, complete capital budgeting. Capital budgeting, again same. Take the practical questions at the book end. Do only those questions. Okay. And with regard to my notes, I have done all the illustrations in the book. Okay. In that, please do capital rationing and also do the EAB, EAC calculation and ranking conflict understanding. Okay. So capital budgeting mainly illustrations, some important illustrations, whatever you feel important, means illustration which contained, okay, illustration which contained accounting rate of return, payback period, NPV, IRR. One illustration on all these will be covered. There are 3-4 illustrations like that. Do 2 illustrations first. After that, do all the practical questions. 3 hours time. In that 3 hours time, you have to complete capital budgeting. Again, 5:30 to 8:30, do your SM. Complete it. 9 o'clock, again, I will come up live. In that live, I will cover the cost of capital. Okay. Cost of capital and Modigliani-Miller approach in the capital structure chapter. And I will cover overall working capital. Overall, sorry, mainly the ratios. Okay. Then that day also will be completed. So regarding the cost of capital, Modigliani-Miller model and ratios, you need not worry. We will cover in live again. Okay. Irrespective of live, you first to do all these. Complete these. After that, the next day, the only thing you will do is in FM, if there is any theory, small theory you will read, and SM. Along with that, parallelly put the working capital chapter and try to prepare. That's it. In the limited time available, if you have to cover both the subjects, this is the way in which you have to. So, totally for SM, you should keep 8 hours only. Then only it will be possible for you to crack the FM paper. Clear? Yeah, that's the point. If you have any doubt, some person asking question, explain with the tax. Okay, so listen carefully. My notes is available there. I have given the clear explanation and question also. Try to do that properly. Okay, if you do that properly, it is more than enough. So mainly 2 chapters I completed now. Another 2 chapters are my target. One is the cost of capital, another one is the ratios. Okay, you have to do at any cost leverages capital budgeting. Leverages and capital budgeting. Do that properly. Okay, in the limited time available, even I should not waste your time now. This is your time. You have to spend time and complete. Now after the live is completed, first to do capital structure questions. Okay, in my notes is available in Telegram group. You take it and complete the notes. If possible, do the Modigliani-Miller approach also. We can save time. Okay, I have given clear analysis and explanation as to how to solve the problem. So just put that, do that. Modigliani-Miller also, if you want, you can try to complete. The main thing you have to complete now is, once live is completed, open the ratios chapter. 1 hour you spend the time and then sleep. In that 1 hour ratios, practical questions, not illustrations, practical questions in my notes. Everything I have done, each and every practical question I have done in the notes. So do that properly. Ratios analysis notes will be there. That notes you copy and you complete it properly. Okay, so ratios chapter practical questions you do now. Okay, try to at least remember the formula. Sir, if you can't do, at least try to read some formula and try to remember. No sir, I can't do ratios now. At least to do a small chapter like leverages and sleep. Okay, at least to do leverages and sleep, but don't waste time. 1 hour you spend, up to 1:30 you be there. At least small chapter leverages you try to complete, such that tomorrow you can save time now. So at least to do leverages and sleep. Everyone, challenge accepted. Will you do leverages? Everyone. Okay, so please, once I complete, take my notes. It is there in the Telegram group. Leverages chapter, all practical questions I have done the answers. Okay, take it. Take the leverages chapter. Randomly take the practical questions and try to solve. Leverages chapter will come for 6 to 7 marks in exam. Small chapter, but good amount of marks will come. Okay, all the very best. Meet you tomorrow live again. Okay, their cost of capital. Their cost of capital chapter is our target chapter. Mainly cost of capital and ratios. Okay, if time permit, I will also do the working capital chapter for you. Or I will do one thing here. Ratios, if you can do, I will take up working capital and cost of capital. Yes, I will do. A data management or factoring problem also I will do. Thank you very much. Meet you live tomorrow. All the very best. Prepare well. 1 day is only there for your last exam. Please give lesser importance to your sleep, higher importance to solving the problem. Complete leverages and sleep. Complete leverages and sleep. Again, I am repeating. Okay. Our target is at least we should gain 40, 42 marks in FM itself. Please give that importance.